Hello and welcome back everyone to our new video. I'm CA Harsh Mehta and today we'll learn about mutual funds. So what are mutual funds? Mutual funds is a simple concept as selecting stocks require a lot of technical knowledge and time to be invested. Everyone cannot afford the time and does not possess the technical knowledge that is required. And hence, here the need arises for professional management of your funds. Here, mutual fund steps in and hires professional managers who possess that technical knowledge and invest their time on a daily basis to track the daily developments in the market. And they park your money in various investments and manage your money by investing the same. So, technically speaking, a mutual fund is a vehicle where a lot of investors park their money, and this pool of investment is then managed by a professional manager hired by the asset management company or AMC as we call it. And that way, your money is professionally managed along with all other investors together. So, to understand it better, let's say that there is a vehicle MF over here and there is a party that is investor who is paying money. Investor pays money to mutual fund company or AMC. Let's say he paid 10 rupees. And in return of that money, mutual fund company allows them a unit at a specified NAV. Let's say if it is 10. NAV is nothing but the net asset value of the mutual fund, which is usually rupees 10 at the time of initial issue of the mutual fund. And a mutual fund in turn hires professional managers to manage this money. Professional managers take this money and park that in markets. So all the returns that are generated by markets are then again given to mutual fund in terms of that unit, and your unit changes based on the profit and loss generated by professional managers in market. Let's say there are 1,000 investors who have parked rupees 10 to in AMC, that is mutual fund. So AMC has rupees 10,000 in all to invest in the market, and AMC gives this money to portfolio managers who in turn invest in markets. That 10,000 rupees invested in is invested in markets. Let's say in 1 month time, the portfolio managers manage to earn a return of 1,000 rupees. So the total asset value that is held at by AMC in this particular scheme now adds up to about 11,000 rupees, including the gain. So what benefit the investors have? That 11,000 rupees means that divided by 1,000 units, that is the total number of units that we had allotted in earlier, gives us a net asset value of 11 rupees. So this NAV is basically the price of the investment of the investors. So the 10 rupees that they had invested a month before is now 11 rupees, and they have had a profit from this investment structure. So this is how the returns are generated from a mutual fund scheme. Mutual funds can be divided based on different criteria. The very first criteria is it can be an open-end scheme or a closed-end scheme. So the open-end scheme is one where you can invest the money and redeem the money from a mutual fund at any business date. That is, you don't have to wait for a specific date at which you will be paid back your money. You can go on any business date to the mutual fund, ask for your money, or you can give them the money at any business date. On the other hand, a closed-ended mutual fund is a fund wherein you can only invest at the time of NFO, that is new fund offer, or the initial offering by the mutual fund. And it has a specific maturity period. Let's say if it's 3 years, then after 3 years, you will be returned all your money back and the scheme will close. And as there is a specified time period in which, after which the mutual fund returns you the money, they are compulsorily liable to be listed on a stock exchange. But the liquidity is very low on a stock exchange, and even if you get a seller or a buyer, it will not be on a favorable terms. So this is what open end and closed end mutual funds are. Another basis of classification is based on the style of management. It can either be an active style or a passive style. Active management is where the manager continuously researches on various stocks in the portfolio and continuously changes the position in every stock based on its research. In active style, the manager tries to beat the returns that are given by the benchmark and to outperform the benchmarks. Whereas in a passive management style, the manager exactly mimics the benchmark. Let's say if it's Nifty or Sensex, then the manager will exactly mimic the portfolio that is under Nifty and Sensex, and hence the return that is expected from a passive management is similar to that of benchmark. Whereas in active management, the return expected are that of higher than the benchmark, but it can vary. It can be lower or higher based on the technical competence of the manager. There are two types of plans that an investor can choose from. The first one is the direct plan. In the direct plan, the investor directly deals with AMC. That is, it transfers all its funds directly to the asset management company. And asset management company directly transfers all the returns to the investor's account. And there is no intermediary in between. Whereas in a regular plan, there comes the intermediary in between, which acts as a basically a agent, wherein all the money transferred or exchanged between AMC and investor goes through this intermediary, and this intermediary charges commission at the time of subscription of the units, at the time of redemption of the units, or at the time of any type of returns that are announced by the AMC. And also the expense ratio are higher when the intermediary comes in because it charges its expense ratio also in inclusion with the AMC's expenses. And so this is the two types of returns, two types of plans basically. And a direct plan is always best as it excludes the unnecessary commissions that are charged by the intermediary. And to directly invest in a mutual fund, one should directly go to the website of the AMC, be it L&T, Sundaram, or any other mutual fund. You can directly go through their website. Just type in L&T MF, Sundaram MF, HDFC MF, and you will be directed to the website and directly invest through their website. The last point to cover is the investment mode. One can invest lump sum or you can start a SIP. A lump sum is where you are investing a particular amount of money, let's say 1 lakh, 2 lakh, 2.5 lakhs, or whatever is your sum at one go in the mutual funds. And whereas in a SIP, monthly amount is deducted from your bank account that goes into the mutual fund. So whether it's a lump sum or SIP is based on your cash flow requirements and cash flow availability. So let's say if you're a business person, you might not know your future cash flows at this point of time. So you, as and when you get the cash flows, you can invest your money and you can remove your money based on your needs. Whereas if you are an employee or you are working somewhere for salary, then you know the exact amount that you will get every month. And the SIP works best as you can park a fixed income. That say if you are earning 50,000 a month, you can park 5 to 10,000 under SIP, and so every month 5 to 10,000 will be parked and transferred under mutual funds from your bank account. So both of these modes are best for suitable for respective persons. So that concludes the topic, the concept of mutual fund, and I hope you got something to learn out of it. Catch you in next video. Thanks.